Welcome back, traders and investors. We have JC Parets on the line, and he is the founder of Eagle Bay Capital. Also, soon to be a new MarketFi maven on Benzinga's MarketFi. So, what inspired your decision to come onto the MarketFi platform?
Well, once again, thanks for having me. But yeah, I've been friends. I've been friends with you guys for years, and really just makes sense. Obviously, managing a portfolio and managing money is really where my passion is, and really what we do. But there's a whole other group of investors that, whether they're either not accredited or they just want to manage their own money, well, there's a market that we can tap, and we have a lot of charts and a lot of commentary and a lot of annotations, and I think we could provide a good service, and it's just a good fit for us.
Yeah, and I think that's something that I've learned here the time that I've been working with Jason and Kyle is that there's really a broad spectrum of investors out there, and there's your people that are your buy and hold people, and day traders, not many as there used to be, but there's really and really since the financial crisis, the old time brokers have kind of gone by the wayside. People are managing their money on their own, and something like MarketFi gives people a lot of ways to interpret the markets. So you're on your way to launching a new fund. Why don't you tell us about that?
Yeah, it's been a work in progress. We've had some funds in the past, and we're really consolidating, all our investors and all our capital into one particular fund, and we're excited about it. We'll be, we're in the process of doing that as we speak, and we'll be live in a couple of weeks. So we're real excited.
Okay, and what are you gonna be trading in that? Stocks, bonds, futures, options, everything, or what's you gonna be trading primarily?
Whatever's moving. I mean, we really do have a non-correlated target. So, we're both long and we're short. I was just listening to what you guys were just discussing, how important it is to be on both sides of the market. I could not agree more. The long-only funds, the long-only portfolios, I mean, eventually that's going to get hit really hard. I can't just sit back and accept a 30% correction or a 50% correction like we've seen in recent years. I mean, to me, that's just unacceptable. So if you're long only, that's for you. Fine. I would never be able to do that. I have to be able to take advantage of both sides, and more importantly, not just in the stock market, but in the bond market, for example. We've been bullish bonds all year. That's been a home run. Everyone assuming interest rates were going to go higher this year. That was obviously dead wrong. Economists, as usual, are not market participants, so they could not have been more wrong, these economists. So that's one of the reasons we don't really worry about the economy. We focus on price. One of the reasons we're so bullish on bonds. And then commodities as well is a great way to keep the portfolio not correlated to the market. For example, what does corn have to do with the S&P 500? What does palladium, for example, this year, what does that have to do with interest rates or the U.S. stock market? One has nothing to do with the other. So we can find opportunities that are not necessarily tied to the economy or interest rates or the stock market or really anything for that matter. And, we love that.
Okay, so some of the participants in the chat room can read my mind, and one of them is Rob Hood here, and he comes up from a question, and this is related to the last time that you were on the show, and that you mentioned that utilities in energy are kind of the late cycle movers, and
Yep.
you were right. I mean, ExxonMobil, a lot of these stocks just took off. And now they've had some pretty substantial pullbacks. I mean, ExxonMobil's pulled back under $100. Does this constitute, the end of the bull market, or is the market just laying the foundation for another move higher with both these sectors relinquishing leadership?
Right. Well, I'll say this, and if you go back and listen to last time I was on, really what I tried to focus on was the fact that I liked energy on a relative basis, because I haven't really been a big fan of the stock market this year, and that's obviously been a good call because for the most part stocks are flat year to date. So I really like energy and materials. Actually, the recent developments in materials have been fascinating as well. I particularly like them on a relative basis, which goes back to what we were just talking about, having that non-correlated strategy, that non-correlated portfolio where we don't necessarily care what the S&P 500 does. In this case, all we're talking about, all we're looking for is the outperformance of energy over the S&P 500, essentially long the XLEs, short the SPYs, same nominal amounts, and playing that on a relative basis. So getting back to that, I really like materials in that particular strategy right now on a relative basis relative to the S&P 500, 100%.
Okay, so going to the materials, I mean, what are you looking at, like a DuPont here or something like that, or what do you throw into the what stocks would you throw into the material category?
Well, something interesting. I mean, just the XLB alone relative to the SPY looks very very attractive. It looks like a look at like a 4-year chart. Beautiful bearish to bullish reversal. I love it. I think it goes a lot higher on a relative basis. Something interesting I like is coal. Take a look at KOL, which is the coal ETF. I've been pounding the table on this for the last couple of weeks. It's been working. We closed yesterday at fresh year-to-date highs. One name in particular that stands out is CLF, which is Cliffs. I think it's got another couple points to the upside. This is a really hated name. I think the street really, really dislikes this. Huge short interest. About 10 days to cover as far as the short ratio is concerned. Bullish momentum divergences on both daily and weekly time frames. I really like this name a lot. It's been working. I think it continues to do well. Same thing with coal. I like the space as a group. I really do. It's very hated. In addition, in the material space, something that's interesting and it's kind of been messing with my mind a little bit is the gold miners. This is another very, very hated space. The reason it's been screwing with my mind is because silver looks terrible.
I know.
Like, terrible. And, I mean, we've been testing that level. We're looking at like a fourth test, man. And that's probably the biggest reason why I'm not totally pounding the table on the gold miners, because there is that correlation. But I'll say this. I think over the years, one of the things that I've probably improved on the best in my money management is really not overthinking it, right? Trading what's in front of you and not saying, oh, well, copper's going down, so we can't buy China. Forget that. If China looks good, forget copper. Just buy the China and shut up. So, I mean, I feel like that's when you look back over the years and see kind of like where you struggle and where you've improved on. That's probably one of the things I've done. I've improved on best. Just shut up and trade what's in front of you. So these miners are interesting. Look at Newmont making new highs of 25. Firms that cover this name, only 2 of them have a buy recommendation. Really? 2? And we're coming off key support from the '08 lows. That's a really interesting name. There's a lot of upside in that name, I think.
Yeah, and the gold futures have been hanging in there as well. So you've mentioned some individual stocks, and then you mentioned that the ETFs. Are they both part of your strategy, or do you just feel you get more diversification with the ETFs?
It's a good question. We're really in both. I mean, really whatever makes the most sense. But from a research standpoint, we use the top-down approach, right? So we work from the top down. So we're looking at all of the individual sectors, for example, the materials, and then we'll break it down. So within that particular sector, there are subsectors. Like, for example, in the consumer discretionaries, you have home builders, and then you have retailers. So you will look at the individual ETFs within a larger sector, or financials, for example. We'll look at regional banks, we'll look at broker-dealers, and they're all individual sectors. So if we like one sector, we'll break it down and look at the subsector. If we like a particular subsector, then we'll look at the holdings, and we'll look at the individual stocks. So, just to get back to what we were just discussing, we're looking at materials. We like materials, fine. So then we break it down even more. What kind of materials? The chemicals, like you mentioned, or more of the mining space, something of that nature? I like the miners, fine. So then you break it down and look at the miners. Oh, wow, look at Newmont. Oh, look, everybody hates it. So you see how we kind of work from the bigger picture and work our way down. Same thing on the short side, right? If I hate financials, I despise them. They've been underperforming for over a year. Just a terrible, terrible sector. Citigroup is at the same price it was 5 years ago. I mean, I just find that hilarious. But it's a terrible space. So then within the financial sector, we're looking at KRE, which is the regional bank space. Looks even worse than financials as a group. Looks like a topping pattern to me. There's no position yet, and there's really nothing to act on. But KRE, we start breaking down below those support levels, below 36.5 or so. I think that's all she wrote, and they're in trouble. but until that breaks, there's nothing to do. So that's really how we approach the market from a top-down perspective.
Okay, now let's just go a little bit to your money market approach, and been having a lot of discussions with different people, and everything is now on a relative basis to your benchmark to the S&P, and staying not necessarily what your returns are, but what the returns are relative to the S&P. And it's hard to argue. The S&P's just done extremely well, and you're in a period now where either topping out or maybe consolidating. I mean, how can you beat the benchmark or improve on the benchmark if you are not capitalizing on the downside and any of the downside action in the market?
Truthfully, I have absolutely no idea. The long only approach to me just makes no sense at all. Like, how could you possibly ignore the other side of the market? I mean, to me, that's just mind-boggling. Um, as far as benchmark is concerned, the S&P 500 isn't even our benchmark. In fact, we couldn't care less what the S&P 500 does. It could go to zero. I really don't care. It's just one asset to us. Whether we're looking the S&P 500, corn, treasury bonds, and Chinese stocks, to me, are all the exact same thing. One is not better than the other. It's just one thing. Unfortunately, to your point, I get compared to the S&P 500 because most investors are just brainwashed to believing that you either have to underperform or outperform the S&P 500. I have no idea why. Who cares what the S&P is doing? There's so much more out there. This is a humongous world with so many countries, so many asset classes, so many commodities that you're going to focus on the S&P 500. Come on, get a life. There's so much more out there. So we really, really pride ourselves in really diversifying and trying to make money no matter what. The S&P 500 could get cut in half tomorrow. I mean, I hope it does. That would be a great opportunity. But we're constantly being compared to the S&P, and I guess there's really nothing that we could do about it. We're just always going to be compared to the S&P, and fine. And then, S&P gets cut in half. It's down 50% for the year, and your portfolio is down 30%. So that should be a good thing. Like, come on.
Okay. Also, geopolitical events. We've had a lot of things going on as of late with the Ukraine, also in Israel on the Gaza Strip, and then the skirmish with Iraq. I mean, I hear you talk. I hear you've talked technicals. I hear you talk fundamentals. I mean, how much emphasis do you place on these geopolitical events, and do you let that affect any of your trading decisions?
No, I mean, truthfully, when are there not geopolitical issues? I mean, seriously, so for me to worry about what's happening and who's going to war and who isn't and what Putin is doing and what he's not doing, I mean, I can't deal with that stuff. I literally just ignore it all. Let people worry about that. Let people on TV argue back and forth on how that's going to affect stocks. And, they just make things up. Like, oh, so palladium is up year to date because of the exposure to Ukraine. Really? Are we really going to go there? And you constantly hear this nonsense of, just because two things happen on the same day means they're related, right? The joke yesterday was, oh, so Kate Spade was getting crushed, so it must have had something to do with the Brazilian plane crash, just because they happen on the same day. Like, one has something to do with the other, so I don't worry about that stuff. There's always geopolitical issues, so if you're going to let these things, affect your decision making in the stock market, I mean, I just think you're barking up the wrong tree.
Okay, and the also your performance relative to the S&P. I mean, it's had a great run. I mean, with your fund, so you're just using your own benchmark and you're not comparing yourself to the S&P.
It would be disingenuous to compare us to the S&P 500 because we really couldn't care less what the S&P does. It's just one asset class. I get it. We're in the United States of America. It's a very popular benchmark. So whether we like it or not, we're always going to be compared to it. So if the S&P is up 30 and we're up 25, like we didn't do our job, like that doesn't make any sense to me. So, one of these days or one of these quarters or years, eventually, the market's going to get absolutely destroyed. It's just the way it is. It's happened before. It'll happen again. We'll hopefully be up very nicely in that sort of environment. And, that's when we can show investors, be like, hey, you see, and investors, listen, all of us, we all have like some sort of ADD. We can't pay attention to one thing. So as much as we pound the table to investors and we tell our guys, listen, we're not correlated, we're not correlated, we're not correlated, then comes a time, hey, the S&P is down 15%. How are we up? It's like, hey, remember, we're not correlated. It's like, oh, okay, now I get it. So, and that goes for me too. I have the same fault. You could tell me something 1,000 times, but until you show me, I'm not going to get it. I guess that's probably why I'm a technician, right? I just look at pictures all day.
Okay. Do you trade futures or options, or you just pretty much outright with the stocks?
Yeah, we'll be in the options, for example. Really depends on the situation. I think a good example that I like to use is we use it for both risk management purposes as well as execution purposes. So, for example, TLT is a good, TLT is not going to move like a Tesla, right? The ATR of treasury bonds is going to be substantially less than your Pricelines or your Googles or whatever people are trading these days. So what we'll do to get the juice, to get the beta, is that we'll be like an in the money calls, for example. So look at TLT. You buy it at 100, it goes to 115. That's a 15% move. Nice, but nothing earth shattering. But you buy the 95 calls, and let's say when the stock's at 100, and you pay $6-7 for it, depending on the time value. That 15% move from 100 in the stock will give you an exponential move in the call option. So it's a little bit more risky. You have to assume more risk, but the upside is definitely there. So we'll use the derivatives to kind of get the juice where we need it. And treasuries, I think, is a good example.
Okay. Do you keep any kind of black swan options or any kind of hedging, major hedge on the overall portfolio, or you just kind of, I mean, it's expensive to do it over the long term and really hasn't been profitable. Do you do anything that in your fund?
I don't at all. Maybe if we were like a long only fund or something like that, for some reason. I mean, unfortunately, we're not that. We're
Okay.
the complete opposite. But maybe if we were a long only fund, I would need to do that. But yeah, to be hedging against a black swan event, no, not for us. And truthfully, the way that we hedge for something like that is really to be in so many asset classes and be on both sides of the market. So a black swan event could come in and could really ruin perhaps a long only stock portfolio, and that could very well happen. But if you're in other asset classes and you're both long and short, sure, maybe one of the positions or a couple of the positions would be affected, but perhaps some of the others will either not be affected at all or actually benefit from such an event. So our hedging is kind of just inherent in our overall strategy. Right?
Going to like the overall market here and the reaction to earnings season, we've kind of observed a lot of pops. I mean, you can take something like a Cisco today, many other issues, ICPT the other day. You're getting these pops in the pre-market trading, and then the drops, and sometimes the issues, even ending up negative on the session. Is that a concerning trend to you?
Yeah, and what's interesting is the analysts these days are lowering they're lowering their estimates a lot more than they're raising their estimates, which is something we haven't seen in a while. As far as the reactions after earnings, that's really not my game at all. I try to stay away from that. I try to avoid stocks going into earnings, or I try to avoid key events, or being too big into an FOMC meeting when they
Right.
used to matter. These days, FOMC meetings are irrelevant. But back in the good old days when these sort of events would take place, and bonds and currencies and precious metals and stuff would move based on these announcements, I would try to be careful in anticipation of that. I guess that's one of the ways that we manage risk. As far as the stock market overall, I haven't been a fan all year, and that's been right. The market for the most part is just flat for the year. The Dow is down or flat. Russell 2000 is down. The micro caps are down. On average, if we have a universe of about 6,700 stocks that we look at, on average, half of them are down for the year. So the United States stock market is just really not where we've wanted to be this year as an average. I mean, obviously there are individual equities, J.C. Penney, for example, and correlation analysis is something that's really important to us. We're constantly stress testing the individual equities or assets to the S&P 500 on purpose. So like J.C. Penney, for example, it has a negative 0.5 correlation coefficient to the S&P over the last month. It has a zero point 0.0 correlation over the last quarter, a negative zero point 0.3 correlation coefficient over the last year. So we love that. Look at a name like Newmont Mining, something that we mentioned earlier. Again, negative zero point 0.5 correlation over the last month, negative zero point 0.6 correlation over the year. We love that. Same thing with coal, negatives across the board. So when you're looking at these names, so sure, we're not benchmarked to the S&P 500, or at least we tell people we're not. We're going to be judged against it regardless, whether we would like it or not. But it's not something that we try to do. So because we have that zero correlation target, we'll look at the numbers. We'll run the correlation coefficient constantly to make sure that we're achieving that zero. And it's obviously impossible to have a zero correlation across the board to the S&P, the 10-year, the dollar, gold, and oil, which is what we're constantly looking for a zero point 0.0 against. But even though it's impossible to have zeros across the board, our goal is to get there, and I think that's good enough.
My final question here. I mean, you talk a lot about your technical analysis and whatnot. What is your preferred? You like to look at daily, weekly, monthlies? Do you have a mix? What's your go-to technical analysis?
Sure, all of them really. So we incorporate what's called a top-down approach, right? So I'll sit there on a Saturday morning or a Sunday morning. I'll get my coffee, put on a little Rolling Stones or something, and I'll look at the monthly charts of all the major averages, monthly charts of all the global markets, commodities, everything, currencies, everything across the board, and then I'll break it down to the weekly charts, break it down to the daily charts, and really work my way down. So I really want to see where we are from a structural standpoint. So the S&P 500, for example, we exceeded the 2007 high. So structurally, the S&P looks incredible. It looks amazing here. But tactically, when you break it down to a daily chart, it's really just not somewhere we want to be. We're stuck in this range. It's just seasonally a bad time of the year. We combine a lot of cycles. So from a top-down approach, that's how we incorporate it. And then in addition, we do a ton of seasonality analysis. We combine a bunch of cycles, presidential, decennial, the one-year cycle. We combine them all into a proprietary composite that we have. We do a lot of sentiment analysis. I want to see what the assets that are hated the most in the world. I want to know what's loved the most in the world, and I would much prefer to take the other side of that, right? Fade the consensus, especially like economists. Economists are the best to fade. Like coming into the year of 67 economists, all 67 of them said that interest rates were going higher. So obviously they got that completely wrong because they're not market participants. They're economists. So when you have economists trying to talk about the market, take the other side of that. I mean,
Okay.
I love fading the economists. We'll a lot of sentiment stuff. We do a lot of intermarket analysis as well. So, for example, we're looking at the stock market, but the bond market gives us a lot of information from a risk-on, risk-off perspective. If there's real risk appetite in the market, you want to see the riskier junk high yield bonds outperforming the guaranteed return treasury bonds, right?
Okay.
But we're not seeing that. In fact, we're seeing 52-week lows in that ratio. As the S&P makes new highs, the bond market is telling us to be careful. So we really incorporate everything. But at the end of the day, all of that is great. It's fine and dandy, momentum, that's fantastic. But at the end of the day, it's only price that pays.
Yeah.
So that's really where everything could say buy it, but unless price is saying to buy it, we're not going to make the move. That's really the most important thing, especially from a risk management standpoint.
Okay, one more question out of the chat, and over the years, you've been managing money. How have you done against the S&P 500?
Well, it would be disingenuous for me to cherry pick different accounts and different strategies, and we've had some private equity funds, and we've had some liquid funds, and different portfolios with different strategies. So in this particular case, we're combining everything into one portfolio.
Okay.
So we'll no longer have multiple accounts, and we'll be able to compare ourselves to really anything. So it would be disingenuous for me to really speak in that behalf. But like I said, we're constantly not worried about what the S&P 500 is doing. We really couldn't care less. I hope it goes to zero. It doesn't matter to me at all. We're looking at so many other things, and that's really what we pride ourselves on.
Okay, J.C. Parets, founder of Eagle Bay Capital and soon to be a MarketFi maven on Benzinga's MarketFi, so we'll be checking out his product. J.C., thanks for your thoughtful analysis of the markets, and we'll talk to you again soon.
Thanks for having me.